folks, now we are taking a further leg down, and we're just watching this with a major sell-off happening at the moment. The Dow is down 364 points. Just to tell you that it was about 55 minutes ago when we started the show, the low of the session was a loss of 332. You can see this is accelerating at the moment. We are heavy volume, experiencing much heavier volume than the three-month average. About 3.7 billion shares are moving right now on the big board. S&P down 50 points. That's a loss of about 2 1/3. Let us bring in a top banking analyst, and we're looking right now, Marty Mosby, at what is going on with the markets. I need you to give me a macro picture at the moment, because a lot of people are saying this is Fed-driven, that the Fed started flapping its lips, and this is the fear of another rate hike. I don't know how people couldn't be ready for something like that.
Well, what you have to realize is just a month ago, the percentage expectation for a rate hike in this entire year was less than a third that even thought it could happen this year. Now when you're looking at it, that percentage has gone up to now 60 to 70%. So we're seeing this expectation shift. When you look at the overall economy and the overall market, you have some shifting of investments into stocks because rates were so low, and we're going to be low so long. So valuations got inflated. That's not the case for banks. So eventually we want to kind of circle back and talk about banks in relation to the market and what this means. Well,
see, I thought that a rate tightening would be good for banks. Banks right now are not doing well. In fact, the ones that are in the Dow, like Goldman Sachs, JP Morgan, are also lower. But Wells Fargo is down for another reason. And I need to talk to you because you have covered Wells Fargo for a decade. They had to lay off 5,300 people because they were putting together, without asking clients, they were charging them money to start up different kinds of banking products in cross-selling, as it's known. And listen, you don't want to get too aggressive here, but does this hurt the stock long term?
So let's put this into context. One, it is inappropriate behavior, and the bank is reacting to that. So we don't want to make light of this. But when you look at the amount of accounts, when you're talking about them opening up additional accounts, we're talking about less than 1% of the overall accounts. We're looking at the revenues that were given back. We're talking about, on average, $25 to the households that even received a payment. So very minimal impact here.
Okay, we got to run. Listen, it's great to see you. Thank you, Marty.